silver is too cheap for these deteriorating monetary conditions. That is absolutely clear. It is therefore going higher. But the question is, you have to ask yourself, I mean, as the price rises, what are people going to do? Are they going to just take profits? Or are they going to say, I'm going to hang on to my silver because things are not looking so good for the fiat currencies, for the dollar, whatever. Gold is going up. Gold-silver ratio currently 84, should be below that. Why should I sell my silver? So I think it's a situation which actually, particularly through the growth of ETFs, a rising price could lead to further demand and less supply, because the supply always has been from weak holders in the paper markets.
Market analyst Alasdair Macleod recently highlighted the sharp sell-off in gold and silver, noting that while the correction appears dramatic, it may be part of a broader, strategically timed move by major market players. Over the past several months, both metals have surged significantly, creating conditions ripe for a technical pullback. Macleod suggests that the decline, roughly 5% in gold and 7% in silver, bears the hallmarks of a coordinated shakeout, where professional traders, sensing overextension, act collectively to trigger profit-taking and margin calls. Despite the turbulence, he stresses that volatility should not distract from the metal's underlying strength, especially given the fragile state of fiat currencies worldwide. Macleod emphasizes that precious metals should not be treated as speculative assets, but as true money, free of counterparty risk, a store of value immune to the inflationary pressures that undermine paper currencies. He notes that central banks, particularly in the global south, understand this dynamic well. Nations such as China are steadily repositioning their reserves, favoring gold over US dollars. The establishment of new gold vaults in Hong Kong and Saudi Arabia, connected to the Shanghai Gold Exchange, signals Beijing's intent to integrate gold more directly into its international trade system. This could eventually pave the way for a gold-backed yuan, offering an alternative to the dollar's dominance in global settlement. Looking ahead, Macleod predicts a major monetary realignment, with gold regaining its central role in the financial system. As confidence in fiat currencies erodes, both governments and ultra-wealthy investors are expected to increase their holdings of physical gold and silver. He believes China will continue to quietly accumulate metals, preparing for the inevitable decline of the dollar-based order. We are approaching the end of the fiat era, Macleod warns, suggesting that the next financial reset will likely be anchored in tangible assets, and gold will once again be at the center of global stability. Now, we present the clips from Macleod's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
You'll get killed. It's as simple as that. Because they're far cleverer people than you, with big, deep pockets, who will push things around. And, if they reckon you're in there, they'll kill you. So really, I think you've got to take, if you like, a more sensible view as to actually why it is that you own gold or silver. And the only justification for that, because they are at a premium price, is because they are money. They are legal money. They are final settlement without counterparty, counterparty, as opposed to credit, which is what a fiat currency is. And if you reckon that the situation for fiat currencies is deteriorating, then that's the reason to hold on to gold. And, whether it sort of goes up 5%, falls 5%, is completely immaterial. The thing to bear in mind is that the value of gold is relatively constant over long periods of time. It is the value of fiat currency which alters, and that has been declining very significantly, particularly since 1971, when the Bretton Woods Agreement was abandoned. So in dollar terms, you had $35, that was the official rate, $35 to the ounce, and we're now looking at nearly 4,150. That tells you basically that a 1971 dollar, or rather the dollar today, is less than 1% in its value of the 1971 dollar. And that's what you've got to keep bearing in mind. It's not a situation that is going to change in favor of fiat currencies. That's for sure. Politically, it would be impossible for any government, in the G7 anyway, to reverse the decline in their currencies. They've been educated, I think, by the macroeconomic establishment, which really started with John Maynard Keynes, to, if you like, use a weak currency to benefit the economy, to stimulate the economy. They're not going to change for that, particularly when freed from the constraints of a gold standard, that they can issue as much debt as they want. And that's what they're doing. So you've got an accumulation of debt, and that's where the crisis now is. What's going to happen to the value of that debt? The other side of that debt is the value of the currency. Debt equals credit. Credit is the currency, and also loans underneath that, which businesses have taken out, individuals have taken out, stock market speculators have taken out. It's the value of that credit which you've got to question. You've got to keep your eye on that. So, short answer to your question is that stackers should maybe say, well, thank goodness we've got a sort of situation which means I can, save a bit more out of useless credit and put it into real money. Let's hope this pause goes on for some time, and then I can really sort myself out. I think that's the way to look at it, not to be spooked by what's going on, if you like, in up 5%, down 5%, whatever. You can see this in lease rates, and basically, someone who's got an obligation to deliver physical metal tomorrow, and if he hasn't got it, he's got to go and lease it from somewhere. The lease rates have shot up. I mean, typically they were sort of up to 30, 40%. And there's some reports of them going up to 100% and more, basically saying, there's no more left to lease. The other thing, of course, is that we see a backwardation, which by definition is when the spot price is above the futures price. And people got very excited with that being over $3 at one stage, which, of course, would prompt arbitrage. I mean, people with silver sitting in COMEX warehouses would think, okay, we'll ship some of that over and make on the arbitrage. So there've been lots of stories about that. Now, how true they are or whatever, I honestly don't know. I'm sure there's a bit of it, but it's probably exaggerated. What I would say is that the backwardation of spot over futures has actually declined now to around about $1. So it's come way, way down. It still indicates that there is a shortage. In other words, a squeeze on those who are short. Because the problem is that the vast majority of the silver in the LBMA vaults is ETF silver. And the other thing which puts additional pressure on the system is, of course, people look at silver, they see silver going up, they probably think they've missed gold, and therefore the silver is a cheap way in. So they run out and buy ETFs. ETFs have to source the metal. And I think it was last week we heard that a number of ETFs, silver ETFs in India, suspended share creation because they couldn't source the silver. And I think on that basis, I mean, really what we see is that silver is too cheap for these deteriorating monetary conditions. That is absolutely clear. It is therefore going higher. But the question is, you have to ask yourself, I mean, as the price rises, what are people going to do? Are they going to just take profits? Or are they going to say, I'm going to hang on to my silver because things are not looking so good for the fiat currencies, for the dollar, whatever. Gold is going up. Gold-silver ratio currently 84, should be below that. Why should I sell my silver? So I think it's a situation which actually, particularly through the growth of ETFs, a rising price could lead to further demand and less supply, because the supply always has been from weak holders in the paper markets. So I think, Jesse, this is a fascinating situation. It's what they call a Giffen good, something which reverses the normal supply and demand relationships on price.
Recent developments in the precious metals market highlight growing stress across the global supply chain. Reports from major bullion hubs indicate that delivery times for standard gold bars have now extended to 4 to 6 weeks, as refiners face overwhelming demand and limited capacity. Alasdair Macleod notes that the surge in buying has exposed deep logistical inefficiencies, with metal often sitting in the wrong regions, such as persistent silver shortages in India and London, while inventories remain higher in New York. Unlike paper or digital assets, gold and silver require physical handling, transport, and storage, meaning any spike in demand quickly translates into real-world constraints. The result is a system straining under pressure, where even minor disruptions can cascade through the global supply chain. At the same time, a subtler but equally important shift is emerging in the gold leasing market. Following the Bank of England's recent outflows, central banks are reportedly re-evaluating their willingness to lease gold, raising concerns about the reliability of leased reserves. Macleod suggests this retreat from leasing is quietly tightening the pool of available physical supply, setting the stage for further price increases. As bullion banks struggle to secure inventory and refiners battle extended delivery backlogs, the market's underlying tension grows more visible. If these trends persist, they could ultimately force a dramatic repricing of both gold and silver, one driven not by speculation, but by the stark reality of physical scarcity.
What you have to do, when it comes to where you store your metal, and whether it's Canadian Royal Mint or whatever, is to take a view on the property rights of that country. How firm are they? Are they likely to be overturned, if you like? Now, it's an interesting point. I've had arguments with people about what happened in 1933 when, you had the executive order, and basically it wasn't a gold confiscation. People say it was a gold confiscation. No, it wasn't. It was a forced submission, if you like, of your dollars for gold at that time at $20.67 to the ounce. So, if you actually had gold, and it was the banks, basically, if you had it in the banks obeyed the government. So, you lost it. On the other hand, if you had it yourself, then you just kept quiet. But it was really when it goes in the system. And if they turn around and do something like that, then you're going to lose it. The difference today is that you have, in America, there is an official gold exchange rate at $42.22 to the ounce. Now, you have to ask yourself the question, would the Americans force the banks to take your gold and gold under the, in their custody and all the rest of it, and exchange it for $42.22 to the ounce when the market price is $4,100 or even more? I don't know the answer to that question. There may be a legal way in which they could do it. So what I would say is you don't store your gold in America, and you don't store it in a vault owned by an American corporation. And that can be in a vault abroad. So I'd say that. I think the Royal Canadian Mint, I would be less worried about, because Canada has some very strong property laws when it comes to property rights. I feel the same in the UK. The same is true in Switzerland. I think the other thing is that there is a big difference between banks who are regulated, and they may well be, I don't know, the regulator, through regulation, if you like. There may be a bit of a danger there. But I think by far the biggest danger with ETFs is that actually, when you own shares or stock in an ETF, it's credit. You do not possess the metal. You do not even have an entitlement to the metal. All you have is an obligation by the manager of the ETF to perform his duties on behalf of you as a shareholder. He's got the obligation, and you've got the credit, if you like, the other side of that obligation. But then it gets more complicated because you don't have a direct relationship, usually, with the manager of an ETF. The manager of the ETF sees as his shareholder either the DTCC or Euroclear, one of those big things. And then it's Euroclear or the DTCC which has the obligation to you. Now, what this means is that in a financial meltdown, when the DTCC or Euroclear or something similar is, if you like, in the middle of failing counterparties, they are perfectly entitled by law to take what you think is yours, shares in an ETF, and deploy it as collateral or even dispose of them, bearing in mind that it's still got the obligation to you, because it'll just say, oh, don't worry, we've got an obligation to provide it, but meanwhile we're using them, thank you very much. Are you going to be like, do you like that? No, I don't think you would. So bear these things in mind. This is the difference between owning ETFs and actually owning the physical metal, either in your possession or in the possession of, or being stored in a vault, clearly your property, in a jurisdiction with strong property rights. The fact of the matter is that there was an explosion of borrowing, debt in other words, when interest rates were suppressed at the time of COVID. You had businesses who were forced to stop trading and needed to finance themselves so they could resume trading once COVID was done. And as well as governments, I mean, you look at governments, the government debt in the US doubled between the end of 2019 and today. I mean, I think it was 23.6 trillion at the end of 2019, which was literally just before the COVID thing started, which I think was 23rd of March or something, 2020. And today we're looking at 47.4 trillion of government debt. So you've got all this debt, and it was all taken out when interest rates were suppressed, when the Fed was going in there doing QE and suppressing yields along the yield curve. So everyone's got all this unproductive debt, and it's basically turned a large portion of the US economy into zombies. And the US government itself, if it couldn't rely on printing money, as it were, is also a zombie. I really do think that there's a time factor here. The longer that we have current interest rates, even if they just stabilize them, the longer we have them stabilized, then what you're going to get businesses falling over. And I think the car loans thing is a classic case, because that's just an agglomeration of debts, everything from good to doubtful to bad. And the idea is, it was the old syndication. Do you remember the property syndication business we had in 2006 to 2008? Okay, there are liar loans in there, but who cares? We can slice and dice this so that the top quality, which we'll sell off to the pension funds, will be AAA. It's the same arithmetic, if you like. You just get a huge, great portfolio of all these car loans, and you can give them a rating which actually is far higher than it really deserves. Car loans. I think also the Main Street, as opposed to Wall Street, is not doing at all well. I mean, it really is not. So you're finding that people, they just cannot afford to pay these higher levels of interest, higher debt rates, and all the rest. Higher interest rates. They're not, they're losing their jobs. They're not getting the pay rises, whatever. I mean, I don't care about job statistics. I mean, they're all wrong anyway. But you can see the underlying economy is actually deteriorating. And even though a lot of government statistics have been shut down because of the debt ceiling, I really do think that there are other indicators which show that the economy is just not good. And under those circumstances, you're going to see more failures. It's quite simple. Eventually, the big failure will be the US government, but that's reflected in a loss of purchasing power for the currency, which is why you have gold, and which is why, when the Fed reduced interest rates a month or two ago, gold took off. And if they reduce it again, gold will take off again. And if they reduce it again, gold will take off again. I mean, because what's the Fed doing? Doesn't care about inflation too much anymore. The priority is to try and keep the economy going, keep the job numbers up.
The coming phase for gold and silver appears to be approaching a pivotal turning point. Years of suppressed prices, growing delivery backlogs, and quiet accumulation by long-term holders are converging into a moment where physical scarcity may finally overpower market control mechanisms. For now, the system continues to function, but only just. The widening disconnect between real bullion demand and futures-based pricing suggests that the current structure cannot hold indefinitely. Once traders and institutions realize that much of the metal they trade on paper cannot be delivered, confidence could evaporate in an instant, forcing a violent repricing across global exchanges. In such a scenario, precious metals would cease to behave like ordinary commodities and instead reassert their historic role as the bedrock of financial trust. A worldwide scramble for tangible wealth could follow, as currencies weaken and central banks struggle to maintain stability. Silver, long treated as an afterthought, may experience the sharpest moves of all, given its dual role as both an industrial metal and a monetary refuge. Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching.